What is going on, guys? Today I'm going to explain how banks are using your own money to make you poor and what you should be doing right now to make sure this isn't happening to you. And make sure you stick around until the end because I'm going to explain exactly what I do with my own money to make sure that it's working for me even while I sleep. If it's your first time here, welcome. My name is Jordan. We talk all about finances, money, building wealth, productivity, and if those are things that interest you, make sure you hit the subscribe button below and the little bell next to it to be notified every time we release a video, because we put out 3 videos just like this every single week. So we are taught all our lives to save. Save for retirement, save for a home. But for many, this idea of saving just doesn't really make sense. Why would I save my money for the future and spend it later when I could just spend it now? What difference does it make if I'm just choosing to be broke now? And this thinking may not actually be wrong. If you go to the grocery store today, for example, and you buy $100 worth of groceries, and then you return to that exact same grocery store 1 year later and buy the exact same groceries, you would find yourself spending about $102. This is due to inflation. Inflation is the general rise in price of goods and services over time. Here in the US, the national average is about 2% inflation every year. So this is why your grandma or grandpa reminisces about buying a candy bar for 5 cents back in the day, but now that same candy bar costs $1.50. Inflation happens for a number of reasons, and one of those may be the government introducing more money into the economy than they can support with tax dollars. And they may do this through social programs, or like we saw during the recent pandemic where they issued stimulus checks. One extreme example of this that we've seen in our recent history was when Venezuela experienced hyperinflation. Hyperinflation is when inflation exceeds 50% every single month. That means if you bought an item for $1 on January 1st of this year and then experienced 50% inflation for the next 12 months, that same item would cost $130 just 1 year later. But this is nothing compared to what Venezuela experienced in 2018, where they saw a 65,000% increase in inflation in just 1 year. That's the equivalent of going to Starbucks and buying a cup of coffee for $3 and then returning just 1 month later and having to spend $16,000 for that same cup of coffee. This is where you see people bringing in wheelbarrows of cash and having to weigh money instead of count it because it just takes so much money to buy simple items. So although that's an extreme, why would any government want to increase inflation? Well, the opposite of inflation is deflation, and that's the decrease in prices of goods and services. And we've only seen deflation during times of recession. During uncertain times, people tend to save their money, but this lack of spending means there's less money in circulation, which means businesses are having a harder time producing an income, and so therefore they have to lower wages and there's less job opportunities, which leads to more people saving money. This snowball effect becomes a vicious cycle, and in the past has led to recessions. So back to the banks. How do banks contribute to inflation? Well, banks operate under what's called fractional reserve banking, which means they only need to keep 10% of the assets that they own in reserves, and they can lend out the remaining 90%. So when you deposit $10,000 into the bank today, they can then go and loan out $9,000 to someone else. This includes car loans, mortgages, credit cards. Repeat this several thousand times and you can see how they are artificially introducing more money into the economy. And on all these loans, the bank earns interest as they are paid back, of which they pay you a small portion through the interest on your savings account. Unfortunately, the national average savings account interest is only 0.06% per year. That means your 10K deposit would only be earning $6 per year, which, better than zero, still does not keep up with inflation. So now you see why saving your money is bad, and the very banks you save your money with are contributing to the problem by creating more inflation. So how do you prevent this, and how do you stop your money from just losing value and sitting in an account? Before I go any farther, if you found this video interesting or helpful this far, please leave a like below. It helps me a ton and it lets YouTube know to share this video with others. Let's get back to it. This is where investments come in, and that could mean anything from buying stocks to investing in real estate or purchasing a certificate of deposit or CD. So let's put this into reality. Say you bought a home 10 years ago in Seattle and you bought that home for $300,000. After about 10 years, that home has gone up about 81% in value. So that home that you bought for $300,000 10 years ago is now worth $542,000. And that's not even accounting for the fact you're paying down a loan and also have tax write-offs for owning property. So let's take this to the stock market. Say you bought $10,000 of an index fund that tracks the S&P 500, which is a collection of 500 of the largest publicly traded companies in the US. So if you bought that for $10,000 back in 2010, and then fast forward to now, you would now have $32,000 or a 220% increase on your money. Even a 5-year certificate of deposit in 2010 had a 2.05% annual interest rate, which means after 5 years, your $10,000 would have created $11,067. Obviously, any of these investments would lead to much larger returns than the 0.06% or $6 that the bank offers. Now, banks aren't all bad. If you put money into a bank, it's guaranteed to be there for 5 or even 10 or 20 years down the road. So they make sense for things such as an emergency fund or a place to store short-term cash for big purchases coming up, maybe a car or a down payment on a home in the near future. Likewise, if you invest in the stock market or real estate, those things fluctuate in value, and at the time that you choose to sell, they could potentially be worth less than you originally put in. But ultimately, safe investments in the stock market or real estate have been proven to deliver higher returns on your money over long periods of time. But now you can see how banks are giving minuscule returns on your money, all while bringing in interest on millions worth of loans and also creating more inflation. And why putting your money into investments has historically produced much larger returns than a savings account ever will. So what do I do with my own money? What companies do I invest in? What stocks do I buy? Where do I put my money? Before I jump into all that, leave a comment below just telling me where you would invest your first $10,000. Maybe that's the stock market, maybe that's real estate, maybe you would buy into gold. Comment below and let me know what you would do with your money. So let's take that $10,000 example and see what I would do first. First thing I would do is pay off any high interest debt I have. Maybe that's student loans, credit card payments, or a car loan. Anything above a 4% interest rate, I would pay off immediately. This is a guaranteed return on your money. Whereas if you invest your money into the stock market or real estate, well, you still have this debt. The stock market or real estate may not have a great year. It may even go down in value. Whereas by paying off this debt, you have guaranteed return on your money of at least 4% plus, depending on how high the interest rate is. The very next thing I would do is I would save for an emergency fund. This is usually about 3 to 6 months of expenses and will cover you just in case the worst happens, like losing a job or getting injured. My next investment would be in myself, and maybe that's putting $1,000 into getting a real estate license or spending $500 on video equipment to start a YouTube channel. Ultimately, these income sources have much higher potential for return than the stock market or real estate. These are active income sources and may not be an option for you depending on where you are at in your life. I would then spend 75% of the remaining amount and put that into an index fund that tracks the S&P 500. This is generally considered a pretty safe investment and has historically produced a 10% return on average since its creation. But history does not guarantee the future, and some years these stocks have underperformed or actually dropped in value. but ultimately they have always increased in value over long periods of time. So these are long-term investments. Then I would take the remaining $1,000 and invest that in higher risk stocks. Maybe that's individual companies that I feel are going to increase in value in the future, or maybe that's investing in an index fund like QQQ that is heavily tech skewed and has been known to produce higher returns, but also is more volatile and could potentially decrease in value as trends change. Obviously, my investment strategy would be different if I was at a different point in my life. If I was older or younger, had kids, or potentially was saving for a purchase in the near future like a car or a home, then maybe an investment like CDs or certificates of deposit would make more sense in those scenarios. CDs are considered much safer investments and have almost guaranteed returns, and they usually can beat or at least stay on par with inflation, so they're much better alternatives than just locking up your money in a savings account. Thanks for watching. If you found this video educational or entertaining, please leave a like as it lets YouTube know to share this video with others, and it helps me a ton. Also, comment down below what you thought of my investment strategy and what you guys would do differently. I try to respond to every comment, so I really appreciate you guys. If you haven't, share this video with someone who could benefit from it, and I will see you guys in the next one.